I would now like to focus on inflation. Global geopolitical developments are weighing heavily on the domestic inflation trajectory. Inflation inched up to 7% in August from 6.7% in July. Acute imported inflation pressures felt at the beginning of the financial year have eased, but remain elevated across food and energy items. Edible oil price pressures are likely to remain contained on improved supply from key producing countries and measures taken by the government. Going forward, there could be some tapering of selling price increases on account of easing supply conditions and softening of industrial metal and crude oil prices. With services activity showing strong rebound and some improvement in pricing power, risks of higher pass-through to input costs, however, do remain. There are also upside risks to food prices. Cereal price pressures is spreading from wheat to rice due to likely lower Kharif paddy production. The lower sowing of Kharif pulses could also cause some pressures. The delayed withdrawal of monsoon and intense rain spells in various regions have already started to impact vegetable prices, especially tomatoes. These risks to food inflation could have an adverse impact on inflation expectations. The Indian basket crude oil price was around 104 barrel in the first half of this year, 22-23, and this is the actual number which has been realized. In the first half of this year, the Indian basket price was, the average was around $104 US dollars per barrel. Going forward, we are now assuming it to be $100 per barrel in the second half of this year. Taking into account these factors, the inflation projection is retained at 6.7% for the current year, with second quarter at 7.1%, third quarter at 6.5%, and fourth quarter at 5.8%, with risks evenly balanced. CPI inflation is projected to further reduce to 5% in the first quarter of next financial year, that is 23-24. The extraordinary global circumstances that caused the heightened inflationary pressures have impacted both advanced economies as well as the emerging market economies. India is, however, better placed than many of these economies. If high inflation is allowed to linger, it invariably triggers second-order effects and unsettles expectations. Therefore, monetary policy has to carry forward its calibrated action on policy rates and liquidity conditions consistent with the evolving inflation growth dynamics. It must remain alert and nimble.